Action. We're rolling. Good morning. Good morning. It is March. Good morning. Good morning. It's Monday, March 24th, 2025. And this is Momentum Mondays. A little earlier than usual, but we'll make it. We're going to look back at the week that was and kind of forward at the week to come, economic activity and things like that. But I'll throw it to you for the fine print.
Yes, this podcast is for informational purposes only and should not be considered investment advice. Always consult a financial advisor you trust before making any investment decisions, or visit us at momentumwealth.us to discuss your specific situation.
Sounds good. All right. Let's get into it with the performance from last week. Let me pull it up.
Today we're bringing this to you from different states. Well, Garrett's still in Georgia. I am in Charleston, South Carolina for a little spring break trip. I had planned to be outside for this morning's podcast, but they decided to begin construction on a giant building right next door, so would not have been able to hear me.
So we pivot. We pivot. All right. So here we are with S&P last week closed up actually half a point. NASDAQ up 0.25. Dow Jones up 1.22. And the Russell 2000 up 0.67. We look at our commodities. We got gold up 1.18. Kind of an interesting discrepancy between gold and silver last week. Silver actually down 2.25. 10-year bond price up 0.57, and Bitcoin was down 0.14. We would basically look at that as being flat. So we look at where we are on a year to date, because it's been a while since we talked about that. So if we look at year to date, S&P's down 3.48%, NASDAQ down 5.94%, Dow down 1.01%, Russell 2000 down 7.5%. And then we move over to the commodities. Gold up 15. Gold is actually leading this year above silver, which is up 14.01. 3-year bond price is up 3.41%, which means the yield on that is down. And then Bitcoin is down 9% on the year. We look at kind of the landscape about, what that means. We've had a pretty rough couple of past weeks in the market as far as some things that maybe we don't want to see, specifically referring to like the moving averages. The indexes seem to be kind of trailing those moving averages. And we haven't really seen anything come and be sort of a driver to that market growth, even last week with the Federal Reserve making their announcement, which we'll talk about in a minute. We didn't really see a whole lot of, I guess I'll use the term animal spirits come back into the market. Like I think we've been waiting to see since we started hitting these lows.
Yeah, I mean, today could be the day. We're looking at, well, first on the chart, year-to-date performance, gold is definitely surprising to the upside. Debt's 3,000 for the first time. We've been in our risk managed gold allocation now for going on, I think, almost 2 years, and maybe right at 2 years. And we've had significant upside in the portfolio with gold. Gold's a great commodity investment. I don't really like using the term investment for it, but it's a great part of your portfolio in small percentages at the right time. And this has proven that the start of this bull cycle going back to late 2023 has definitely been the right time to be allocated to that. Now, Bitcoin being down and the indices being down year to date, I don't really pay attention to. There's those two. Bitcoin is in its own cycle. It's kind of doing its own thing. Now we just happen to be at a point in time where both the major indices and Bitcoin and crypto at large are both down at the same time. But there'll be periods of time, most likely this year, where there's going to be a significant divergence, where you're going to see Bitcoin up, stocks flat. And then probably next year, you're going to see a divergence. We're going to see stocks flat or up and Bitcoin down. I don't really pay too much attention to a lot of the red on the screen, but I do like seeing what gold's doing. Also, bonds going up is great. That means interest rates are falling. Mortgage rates, I think we're now in the 8th consecutive week. We're solidly down to 6.5 if you're looking for a new home purchase. 15 years or below 5.5. So we're seeing some really good traction and movement on that. But today, some really exciting things happening pre-market. And if you're, if you can't tell by the slower pace of our discussion so far and the coffee we have, we are doing this pre-market. But looking at Dow futures, the headline here is Dow futures jumped more than 400 points on reports that Trump will hold back some tariffs. I'm not really sure if that's tied necessarily to the tariff discussion It could be that, again, what we've talked about here for weeks, the cyclical nature of this weakness, some of that weakness being exploited for um, opportunistic trading, algorithmic trading, and it could just be the end of that weakness. Eventually sellers are exhausted and buyers rule the day and sellers rule the day. And so that could be what we're seeing.
In a bull
Also,
market.
very well,
In a
it
bull
could
market.
in a bull market, correct. Your sellers generally are going to be selling on margin. They're going to reach a point where they're going to take profit, meaning they have to buy. Um, all short sellers at some point become buyers. But it could have something to do with some of the backroom discussions, some things the street's aware of as it pertains to some of the big tariff announcements that are coming on April 2nd. But the Dow futures are up, and if we look, some of the pre-market leaders that we have today. Um, Tesla's a big one. Viasat, Pinterest, Nucor, as SEC, and Nvidia is also doing pretty good pre-market. And Tesla's actually doing really well pre-market. Um, up about 5% pre-market just a moment ago. And a lot of these big tech names, which is odd because of how large the market cap is, we're starting to see pretty big swings in these large market cap names. Tesla's one of those this morning that's up a lot. And I guess, it kind of reminds me of the old saying that there's all publicity is good publicity. There's no such thing as bad publicity. We may be seeing that playing out here with that particular name. Been a lot of negative sentiment in the news. Um, but it seems to be doing really well.
Also a lot of buying though. Retail buyers are coming to the table for Tesla specifically in droves. And so while you may see some of the more institutional money maybe moving away from that, and I'd have to look at that because I don't even know if that's the case. I'm just guessing there, but the retail investors have really come in and sort of picked up the slack there and started buying Tesla quite a lot over the past.
Much so, if you go back to December and you're looking at Tesla almost at 500, I think intraday we did go over 500 in mid-December. I mean, great buying opportunity if you've been inclined to
Yeah.
already purchase. Same thing with Nvidia, and we saw this with Nvidia last year when it had a pretty significant pullback. A lot of retail was, just kind of biding their time, and I think that the more decentralized information gets, and the more there's a social aspect to investing, which can be a bad thing, but I'm just talking about the positives of it right now. Your retail over time seems to be getting more and more intelligent as a collective when they're timing these dips, and so it's pretty interesting to see. And I will say, just on that particular name, which again, one of these news stories that kind of made me think, well, I guess it's true. There's no such thing as bad publicity. If we look at the Model Y, the new Model Y, which is Tesla's crossover, which is I think what you purchased, the Model Y, they it kind of changed some of the trim levels. Their inventory is completely sold out in, I'm not going to read all the states, but it's around 25 or 30 states that's completely sold out. So I guess just the name being everywhere kind of works its way through the ether. I don't know, but that's pretty interesting to see. Um,
Well,
Significant action on
you're
that.
also not seeing any analysts change their price targets. I mean, they maybe come down a little bit, but they're not changing it drastically. You're not seeing people bring their price targets down from 400 to 200. I mean, they're maybe modestly revising them, but they're still, its average price target, I think, across all analysts is probably 30% higher than we are today. So I mean, you've got some room to run. But I also think people can look at what's going on in the news and make their own determination about what they think about it. And I think that's probably what we're seeing.
Yeah, it's pretty interesting. And excuse me, that wasn't the refresh trim. That was the legacy trim that was still in production at the beginning of the year. But interesting articles there. And we're seeing some very interesting price movements. The indices up really big pre-market. So we'll see how that sticks and how that holds. A lot of times what happens pre-market one way or the other can get traded away pretty quickly. But as of right now, pretty good. We got Bitcoin. Looks like it's going to be reclaiming the $90,000 mark here very soon. And yeah, but I guess that really brings us into, if sentiment has truly shifted, could it be as a result of what happened last week with the Federal Reserve Open Market Committee?
Yeah, I don't know. The Federal Reserve, it's one of those things that um, they have a very interesting job, which is that they have to say a lot without saying a lot. So it's kind of like this sort of fine line that they have to walk. But the Fed left rates unchanged last week, so we're still, between 5.25 and 5.5, as widely expected. Their message seemed to be patience. He wants more confidence. Jay Powell, being the Federal Reserve Chairman, wants confidence that inflation is cooling before they consider any more rate cuts. And so I think that falls in line with what we were kind of expecting, that maybe the summertime would be the first time we would reevaluate, maybe see another cut. But, it's just one of those kind of wait and see things. Um, and the bond market seems to be pricing that in. It's kind of moving that way, with bond yields edging higher, because of those delayed rate cuts. That just means people will be able to get higher interest rates on the shorter end of the curve. We talked last week, about those yield curves and how you kind of want them to steepen as you go out in duration, meaning longer term bonds pay you a higher coupon rate. And we're not, that's still not what we're seeing. Maybe a little bit, but it's basically kind of flat when you look at the yield curve. You can get, we specifically referenced the short term, like T bills. You can get nearly 5% for those right now, just in the ETFs. The yield on those things are still pretty high. So we're going to have to see a lot of that shift around. It's just anybody's guess is when that's going to happen.
Yeah, I thought the most interesting aspect, which we predicted here on the Momentum Monday podcast 3 weeks ago now, that the balance sheet, there's going to be clarity on the roll off, the quantitative tightening policy that they have. And there's going to have to be, basically our opinion is that the bond market is screaming at the Federal Reserve to stop quantitative tightening. And it really makes no sense to continue that while you're easing monetary policy. And so they did clarify and make an update to where they're going to be lowering the cap on how many bonds they're redeeming, which takes cash liquidity out of the system from 25 billion of treasuries to 5 billion. That's a big drop. Now, and the Fed always does this when they make kind of a behind the scenes move that's a little more nuanced and subtle that people aren't really paying attention to. They'll be like, oh, there's nothing to see here. And that's one thing that Jay Powell stated, which was, oh, you shouldn't read into this at all. This is just us following a predetermined path. Well, no, it's not. It is something to pay attention to. It's pretty big change. And that means the next change is going to be no more redemptions of treasuries, most likely by the end of summer, I would say. So
And
that's a
so,
very good sign.
so what kind of effect does that have on the economy? I mean, it's not, when you stop QT, it's not the same as, there's a lot of people that compare it to, you know, when QT stops, it's going to be like starting QE, which is quantitative easing. I don't know that I really necessarily agree with that, but what effect does the pause or the stopping of the quantitative tightening have on markets or buying power, I guess?
Yeah, so just think of if you're stopping quantitative tightening, doesn't mean you're easing. It means you're maintaining a certain level of liquidity relative to the Federal Reserve's balance sheet and its effect on market participants and the economy. So when you stop quantitative tightening, you're simply holding the amount of think of it like if you have a credit card balance and you're constantly transferring that balance over to a 0% offer over and over and over again. That's holding everything steady. You're not adding to, but you're also not paying down. So with quantitative tightening, they're paying it down. Now, you would think, well, that's a good thing. And potentially it could be, but the problem is that when you're in an environment where the yield curve needs to steepen, we have got to get interest rates down, especially as it pertains to financing the federal deficit, or we're going to be, up the creek with no paddle. So it's what the Federal Reserve is doing is every time that they're continuously rolling off or redeeming the bonds that they're holding is the best way to look at it. They're putting more pressure on market participants to finance the federal deficit, which is becoming it's becoming quite large. It is quite large, and so if you're trying to ease monetary policy to try to become more neutral, then you would want to work towards not doing any more quantitative tightening so that you're maintaining an even level of liquidity, allowing the market to adjust. And that's also going to give the federal government a little bit of an easier route to start refinancing debt, hopefully at lower interest rates. So it's all something that, they've done they've reduced their balance sheet quite a lot, but it's not the same. It doesn't have the same effect as the federal government, for instance, reducing their debt. Because what
Right.
you know, when the federal government's debt is repaid, that money is continuously still cycled through the economy. When the Federal Reserve receives repayment of debt, they delete the currency. So
Right.
that way to look at it. I'm sure I'm getting a couple of things wrong because there's so many moving parts, and
I'm sure somebody in the comments will let you know.
that's fine. Let us know. It's okay. I'm But but yeah, no, all in all, we want to see quantitative tightening come to a stop. And especially we're doing it with treasuries. Now we got to watch what they do with mortgage-backed securities. That will also help the mortgage market. And I think it's important for them to err on the side of more liquidity than less, because a lot of times the Fed will break something before they realize that they've broken it, and it causes problems for everyone. So I think taking a cautious approach, both on how quickly you reduce rates, but also how quickly you reduce the balance sheet, is appropriate. And I think we're seeing that he's not moving as fast as I would like, but I think at this point it's like gravity. It's what has gone up is coming down as it pertains to interest rates, and it's just a matter of time. And a lot of it is going to have to do with what happens in Washington around the budget talks in the fall. And are we going to be able to reduce that deficit and get it back to what I think is 2019 levels? And these things have happened. These things have happened several times in history of the country. If you go back to World War II and you look at how much we increased wartime spending, these discussions happen. How do we get the deficit down? And the economy really took off. We saw the same thing in the 90s, where after the end of the Cold War, how do we get the deficit down? We 1999, 2000 with a giant budget surplus, and you know look at how much the economy has grown since then, even accounting for the booms and the busts of those 2 decades that came after that.
Yeah, that's an interesting correlation. The difference there would be that we didn't just come out of a giant war. And so, is it going to look a little bit different this time? The other thing I would say is that, like consistently I've heard, even from our client population and others that I've talked to, is that like this aspect of communication of particularly, we're moving on from the Federal Reserve, but particularly the administration talking about the deficit and cutting spending and all this kind of stuff, that communication is what's been lacking with the Trump administration kind of telling people what is going on and what's happening, and there have been the opportunity for a lot of news headlines to pop up and really kind of the sky is falling type stuff. And so did you get a chance over the weekend to watch either of the podcasts that Howard Lutnick or Scott Bessent went on? There's like an hour and a half to 2 hour long podcast,
Yes.
long form conversation where they're talking specifically about how they're going to do it, like in real world terms.
Yeah, Howard Lutnick. I think I got everything but the last 20 minutes of his podcast, which Howard Lutnick is extremely intelligent individual. He runs Cantor Fitzgerald. He lost
He did.
his
He doesn't right now.
Yeah, he did run it. He brother, along with several hundred coworkers, several close friends during 9/11. If people aren't aware, Cantor Fitzgerald was the hardest hit business as it pertains to the loss of personnel on 9/11, and just really a bipartisan guy. Very interesting part of the podcast. He talks about how he had been close friends with. He calls him DJT.
Yeah, DJT.
And also close associate of Hillary Clinton, because of how much she helped him in getting 9/11 victims. And I thought that was so refreshing to hear someone that is so involved, extremely involved in the White House, very involved in the tariff policy, but someone that is very balanced, very moderate, very right down the middle. And so that tends to remove doubt when you're listening to somebody like that talk and they're telling you their life story, and you can see an objective. He's objectively down the middle, and he's more concerned with trying to do the right thing necessarily than scoring political points. I just thought it was a very interesting, refreshing discussion. But what did you take away from some of the things that he said to the All In podcast besties, as they're called?
Yeah, first of all, if you haven't watched it, if that's your thing, if you're at all interested in what the angle of the Trump administration is towards the deficit and also the debt, the federal debt. That is a perfect podcast to watch. And then Scott Bessent's is also. It's on All In Podcast is what it's called. You can find it on YouTube. There's, it's over an hour long, but it's very interesting. I just took away that they should be doing more of that. They should put I mean, he talks about going in and being a part of the team that was sort of vetting the nominees for the administration and how they had, images and clips of them. They had built this whole software system that they could throw up on televisions around the room, and they would have, if they clicked on one of them, it would present them with like a couple of 20-second short clips of them speaking, because they wanted people in the administration to be able to be comfortable with explanations and talking to people and telling people what they're doing. And I think that's a great idea. And I think they need to lean into that. I think that this doesn't need to be the last one. They need to put, RFK Jr.'s been out there. They need to put Tulsi Gabbard out there. They need to get Cash out there. They need to get these people out there so that they can talk specifically to the people, um, unfiltered. They're not going through a third party. They themselves are speaking. You can judge on the merit what they're saying, and you can say, yeah, this makes total sense, or no, I think these people are crazy. But I don't think you're going to come away thinking they're crazy. I mean, they're the whole thing is that the path that we're on is unsustainable from a debt
It's
level
object.
and from a deficit
Yeah.
level.
Yeah.
And so
And
people want to make the argument too about Social Security or the sort of spending programs. And there's a clip going around on the internet of him, like a very short clip, giving an example of how his mother, wouldn't call Social Security if she didn't receive her check. She would just think there was a problem and she would just wait till next month. And that people are taking this clip out of context. It's absurd.
oh yeah,
If you listen to the whole context of the conversation, he does nothing but fight for Social Security. He doesn't want to accept that one of the solutions has to be to raise the Social Security age for generations that are coming up. He doesn't want to accept that. They want to figure out a way, and the Sovereign Wealth Fund is one of them. He talks about that too. Is one of the ways where they are going to try to shore up the Social Security program to be sustainable and to be able to last. And I don't. I mean, he's telling you that. He's just telling you that.
a lot of those guys have said that. Now I do understand, and we've had lots of discussions with clients as it pertains to this, and I understand because historically, especially on the campaign trail, a lot of politicians are they want to impress the voter base by talking about what can we tweak here, what can we do here. Oh, I have a solution for this and I have a solution for that, but really they're just fighting over breadcrumbs because we are the wealthiest nation on the planet, and if we can get our house in order, um, and this is one thing that I believe I want to say it was either Elon Musk or something that he had retweeted, where there is no reason actually if you get the Social Security system functioning correctly in conjunction with a lot of changes that they're doing, there's no reason why we can't increase benefits to current recipients. Now, I don't know, you'd have to look at the specifics of that, but from a 30,000-foot view, especially if you listen to this podcast and you listen to Howard Lutnick, the Commerce Secretary, who is over the tariff policies and is one of the individuals tasked with the sovereign wealth fund, when you hear him talk and explain this, it is absolutely true, because these are very wealthy, very successful, a lot of them self-made, in that they didn't start with a base of money. And some of them did, and that's fine. I'm not knocking that at all. But you have a lot of people that really pulled themselves up by the bootstraps and became titans of their industry. They understand finance, and it's very interesting to listen. I would, yeah, greatly encourage. I did not listen to the Scott Bessent one. I did listen to one interview that he did, that I thought was very interesting, about um, contracts for improvement that were supposed to be finished in 1996 for the IRS, and
Yep.
they're still on. So because it's paid for,
Yep.
it's time, not paid for performance or completion. I thought that was interesting. But yes, and I think the dance that has to be done, I think investors would appreciate this. And that may be what we're seeing materialize today with more information coming out about the tariff policies on April 2nd. The dance that I think they're trying to do is being transparent with tariffs, but at the same time trying to hold some back so they could be negotiating. And I'm not sure that's kind of what you're saying. That's kind of Trump 1.0. And I think the market is just tell us what's going to happen. Let's just deal with it to do it. And the more information, the better. And I think that just may be a step change in market expectations. And so, but it's very interesting to see that, and just the non political mindset that a lot of these guys have is something I was not aware of until you sit down and listen in a long format and
Yeah,
really
that's the key.
listening to it. And it's and a lot of these guys, they are lifelong Democrats, and people don't. A lot of people don't realize that. I did not realize that until you start really listening. Several of them, a lot, and they're really purely focused on trying to correct the ship and get our balance sheet right. And I'm going on a rabbit hole here, but I just real quickly, where I live, I have some property in west central. Well, it's not central, but it's on the Georgia Alabama line on the Georgia side near Auburn University. So kind of that east central, west central, east central Alabama, west central Georgia. Um, and there's a lot of timberland where I live. One of the before Ted Turner became the largest landowner, there was a gentleman. His name escapes me, but it could always be looked up, and you could fact check me in the comments. That was from the area that I bought land in back in 2019. He has since deceased, but during the 20s and 30s, 1920s and 30s, he bought up timberland, and he would buy it as cheap as he could get it during the Depression. He would sell the timber off of it, use that money, buy another plot of land, sell the timber, et cetera, et cetera. So when he passed away, that's all held in a trust. It cannot be developed. And so there's tens of thousands of acres, in the vicinity, local vicinity that I am. And he ended up owning 1.2, 1.3 million acres. And they're all the time going through cutting trees and planting new. It's just like a constant cycle. It just made me think, when you think about the the wealth of the country, you think about a sovereign wealth fund. Trump and others in the past that have been more protectionist about trade do have a point, specifically when you look at lumber. You know, we are sitting on vast, trillions of dollars worth of lumber in this country, but we're still importing it. Before the Russia-Ukraine war, almost all of our cabinet plywood came from Russia. Most people don't realize this. A lot of our lumber comes from Canada. A lot of those trees they're cutting down in Canada are the lungs of the planet. So if you're concerned about, climate change, and you're concerned about the quality of the air, you'd probably not want to be, taking out of the tundra all of these trees to make inexpensive plywood and products, when we in this country we have hundreds of millions of acres that could be easily opened and accessed and generate wealth for the country. So I don't know, it just made me think, because I'm seeing all this activity where they'll burn 1,000 acres and plant, and just it's just when you hear things discussed in constantly, we have a $36 trillion debt, which is true, and it is large relative to our GDP. But then when you think about the fact that we have 500 trillion to 1 quadrillion worth of assets as a nation, we just have to get our house in order. It'd be interesting to see how it plays out, but untold amounts of prosperity can be unlocked if we do it the right way, I believe.
Yeah, and they talk about that too in I think it's Howard Lutnick's podcast. I could be wrong though. It could be Scott Bezins. In one of them, they talk about the fact that we're buying resources, particularly for the lithium batteries that we have here in the U.S. There's somewhere it's located. Every piece of those EVs and the batteries, every single piece of them could be found here, and we can get it much better and much cleaner than they do in other parts of the world. And we should be doing that. And so that's another part of those sort of the tariff conversation, is that let's get that sort of stuff happening here in the US, and let's create
Yeah,
jobs from it, and
I
let's
think
do it properly, and let's keep the air clean, and let's keep because a lot of the stuff they mentioned that it's some of the minerals come from Australia, and the way they do it is very dirty, and that air reaches us in like 3 or 4 days. And
yeah.
so it's all of these things that are directly affecting us, but we don't really think of it that way.
Yeah, and I think the best way to think about it, so don't get us wrong, there's definitely um, as it is with any change of policy, there's always both sides generally have a point in their opinions, and so it's perfectly reasonable to whether whatever side of the political spectrum as an investor you lean on, it's perfectly reasonable to have an opinion, to agree to disagree. But I do think it's healthy, specifically in the tariff discussion, if you're really interested in it and you're really trying to understand what's going on to build confidence in your investment plan, to approach it in a non-political way, because I think you're going to come away with a lot more information, because it really does seem that a lot of the tariff policies and the guys that are actually running that are very non-political in their desires to change things for the better. So, you always, with any president, you always have to look for, as an investor, you look for the silver lining of what's going on, either to make investment decisions, to decide to get to be tactical and decide to get off the cash and into the market, or just to try to better understand how your investment strategy is going to perform if you're maybe overexposed to politically sensitive areas of the market. So I would just encourage people to do that. Look at it for certain discussions, again, perfectly reasonable to look at it from a political perspective. But I think with tariff and with the debt, you're going to come away with a lot more useful data and more interesting analysis if you do approach it from a non-political perspective, because I think that from what I can tell, the main drivers of those policies are genuinely coming from a bipartisan background. So it's very interesting. Definitely encouraged. The All In podcast has been something I've listened to for years. Just a lot of just really great information that's out there. But let us move on.
We'll move on to kind of some things we're watching this week. You got your durable goods orders tomorrow, and your consumer confidence on Wednesday, new home sales on Wednesday, jobless claims, and the Q4 GDP final estimate there coming on Thursday. And then the Fed's preferred inflation gauge, which is the PCE, is going to come on Friday, and along with the spending. So we'll see kind of where that leads us, and if that leads the Federal Reserve to feel more confident in their trajectory to potentially cut starting in June-ish. I don't know. So we'll see. We'll see how it works out.
Maybe May. We'll see. That kind of rhymes. I like that. Maybe May. I did also see.
Does that rhyme?
Interesting. Looks like Louisiana is going to be getting a steel fabrication facility of some sort for Hyundai. It looks like they're going to be announcing a $20 billion investment today. I'm not sure exactly where in Louisiana that's going. Seen, we have a lot of clients in Louisiana. They've been the recipient of a lot of big construction projects as of late. This is another one to add to the list. Close to home for me, because the Kia factory is 4 miles from me in Georgia. They're going to be basically beginning to vertically integrate some of their manufacturing instead of just bringing all the parts here and then putting it together like a Lego set. A lot of the parts are going to start being made domestically, and you're seeing Hyundai do that. So, great for Louisiana to be getting some of those jobs. So again, I'm not sure exactly where that's at, but that just kind of adds to a constantly growing list of giant investments that the Cajun state is continuing to get.
Yeah, 1,500 jobs, it looks like. So that's great. That is great. All right. Well, we kept it maybe a little bit short today, but my light just turned green, which means I guess the market is open now and it is positive.
Yeah, we are up.
So it's always good to see. Anyway, I would say that we're still in market conditions to where we could go either way. That's kind of what I've been talking to people about over the past few weeks. We just want to keep our eye on certain things and the movement of those things. As far as underlying market health, we're going to keep our eyes on that. And if you don't have anything else to add, that's it for us. We'll be back next week with another episode, maybe in person this time. Your travels, I think, will be over by next week. So
yes,
you should be refreshed and healthy glow.
Been drug around this town by women and children. So,
all right. Well, if you liked this video, be sure to like it, comment on it down below, and don't forget we're also on audio platforms. You can listen wherever you listen to audio, and we will be back next week. Thanks for watching. We'll see you later.
Take care.